You look at your phone screen and see a number reflecting your bank balance. That single digit determines what you eat, where you sleep, and how you will spend the next week of your life. The anxiety of an approaching rent payment, the relief of a deposited paycheck, these are deeply human experiences. But thousands of years ago, money dictated survival, power, and the fate of millions across a sprawling empire. Romans built an intricate financial machine that powered the greatest military and engineering achievements of the ancient world. They didn't have digital screens, yet they possessed a highly sophisticated system of credit, banking, and corporate investment. At the center of this financial ecosystem stood the Roman bankers, known as the Argentarii. These professionals operated from stalls in the Forum, the busy commercial heart of the city. Citizens deposited their silver coins with these bankers for safekeeping. The Argentarii paid interest on these deposits, then lent the money to merchants, farmers, and politicians at a higher rate. They kept meticulous written records on wax tablets and wooden boards. Every transaction, every loan, and every debt was logged with absolute precision. When a citizen needed to make a large purchase, they instructed their banker to transfer the funds directly to the seller's account. This system of written transfers allowed commerce to flow rapidly without the constant physical movement of metal. Physical cash remained the lifeblood of daily survival. The empire ran on a standardized system of metal coins. The foundational coin was the silver denarius, representing a day's wage for an unskilled laborer. Smaller transactions relied on the brass sestertius and the copper as. The elite traded in the gold aureus for massive purchases. The Roman state stamped the emperor's face on every newly minted coin, guaranteeing its weight and purity. This standardization meant a silver denarius minted in Rome held the exact same value in the distant markets of Egypt, Gaul, and Syria. Traders crossed oceans and deserts knowing their money held intrinsic, unquestionable value. Debt drove the Roman economy at every level of society. Ambitious politicians borrowed staggering sums to fund public games, build monuments, and bribe voters. Julius Caesar borrowed millions of sesterces to finance his rise to power, betting his entire life on military conquest to repay his creditors. Ordinary citizens borrowed money simply to survive crop failures and harsh winters. The legal interest rate was strictly capped at 12% per year by the government. Lenders enforced these contracts with ruthless efficiency. If a debtor failed to pay, the creditor seized their land, property, and sometimes their freedom. Wealthy senators acted as private lenders, quietly financing the debts of entire foreign nations and extracting enormous profits from the interest. The Roman government outsourced its most massive financial operations to private companies. These early corporations were run by syndicates of wealthy businessmen called the publicani. The state lacked the bureaucratic infrastructure to collect taxes, supply the legions, and build aqueducts on a continental scale. The publicani stepped in to fill this void. They bid on massive state contracts at public auctions. To raise the vast amounts of capital required for these bids, the syndicates issued shares known as parts to private investors. Ordinary citizens bought these shares to earn a portion of the company's profits. These shares were traded daily in the Forum, fluctuating in value based on the success of the company. It was a functional stock market centuries before the modern era. The most lucrative business for the publicani was tax collection. The Roman Senate assessed a fixed tax amount for a newly conquered province. The publicani paid this entire sum upfront to the Roman treasury. In exchange, they gained the legal right to extract taxes directly from the provincial residents. They sent armed agents into the provinces to collect the money. Any excess wealth they extracted beyond the original assessment became pure profit for the syndicate and its shareholders. This system incentivized ruthless exploitation. The agents stripped provinces of their wealth, leaving local economies completely devastated. The immense profits flowed directly back to the investors in Rome, funding the extravagant lifestyles of the elite. Managing this wealth across 3 continents required extreme logistical precision. A merchant in Rome buying grain from Alexandria could not physically ship chests of silver across the pirate-infested Mediterranean. They utilized letters of exchange instead. The merchant deposited funds with a banker in Rome, who wrote a strictly formatted letter to a corresponding financial agent in Egypt. The Egyptian agent released the local currency to the grain seller based on that written guarantee. The bankers settled their accounts locally through complex ledger entries. This ancient clearinghouse system allowed massive international trade to flourish safely. Capital moved at the speed of a galloping horse and a sailing ship, unhindered by the physical weight of the metal itself. The interconnected nature of Roman finance created systemic risks. In the year 33 AD, a massive financial panic struck the empire. The crisis began when the government suddenly strictly enforced an old law requiring senators to invest a large portion of their wealth in Italian land. To buy the land, wealthy elites rushed to call in their loans. Debtors could not pay. Lenders refused to issue new credit. A devastating liquidity crisis paralyzed the economy. Land prices crashed, businesses failed, and prominent families faced sudden bankruptcy. The panic threatened the stability of the entire empire. Emperor Tiberius intervened with a massive government bailout. He took 100 million sesterces from the imperial treasury and distributed it to reliable banks. He mandated that these banks provide zero-interest loans to desperate landowners for 3 years. This injection of liquid capital immediately stabilized the markets and ended the panic. The ultimate purpose of this financial machinery was maintaining the Roman military. The legions required constant immense funding. Soldiers expected regular pay in silver coins alongside retirement bonuses of land and cash. The state dedicated over half of its annual budget exclusively to military expenses. When tax revenues fell short, the emperors debased the currency. They reduced the silver content of the denarius while keeping its face value identical. This hidden tax allowed the state to mint more coins and pay the soldiers. This deliberate devaluation caused severe inflation. Prices for bread, olive oil, and wine skyrocketed. The purchasing power of the average citizen evaporated. The relentless need to fund the military forced the state to constantly manipulate the very foundation of its economy. Roman finance operated with cold, calculated efficiency. It transformed agricultural wealth into liquid capital, enabling the construction of road cities and monuments that still stand today. The system enriched a small group of elites while binding the masses in chains of debt. It demonstrated the profound power of credit, the destructive nature of unchecked corporate greed, the necessity of standard currency, and the inevitability of financial crises. The mechanics of money in the ancient world directly mirror our modern economic realities. The tools have evolved from wax tablets and silver coins to digital ledgers and electronic transfers. The underlying human drives remain completely unchanged. The pursuit of wealth, the fear of ruin, and the complex mechanisms designed to manage both were mastered by the Romans 2 millennia ago.